part of the consensus line of thought this morning is that we knew there was a pull forward. We knew there'd be a quarter in which that was evident, and that the pullback, according to at least some on the street today, is that would bring an opportunity to buy. Are you in that camp?
We are firmly in that camp. We think there's still a lot of runway ahead. And look, you got to keep in mind, this is a business with 200 million, plus subscribers. And so whether you add 4 million or 6 million in a given quarter really doesn't move the needle all that much. And I think, a couple of areas, Carl, where we take a lot of comfort is the fact that engagement, according to the company, is still up year over year. And that speaks to the long-term opportunity and the pricing power of the model. And churn remains, fairly low and lower than I think folks would have expected probably, coming out of the pandemic. And so, as we look at the long-term opportunities, the penetration upside, we do like this as a buying opportunity here.
Huh. Heather, I wonder how you think of the name now that we're in this new environment, and Reed himself said it's a little wobbly right now, where it's really going to depend on the slate, and budgets are going to count, and what Disney does is going to count. It's not having the sandbox to yourself like they used to.
Absolutely. I think in many ways, this Q1 story is a story of major Hollywood studios winning the battle. It remains to be seen if they're going to win the war. Now, I agree that there's a huge amount of headroom still for Netflix and the other streamers as well, with 200 million subscribers worldwide. They're really going after the linear TV space, right? So there are nearly 800 million TV subscribers worldwide outside of China. And that leaves a lot of headroom still for them. But in Q1, we're seeing some really interesting trends happening with the Hollywood studios launching their services, Disney Plus reaching over 100 million subs. And, over 95% of the new subscribers in the U.S. to video streaming services were not Netflix in Q1. So that speaks to the rise of these Hollywood direct-to-consumer services.
Yeah, and yet, Heather, they said during the call they don't believe competitive intensity materially changed in the quarter or was a material factor in the variance as the over-forecast was across all of our regions. Does that make sense to you?
No, I think they're soft pedaling. I think that this is really the beginning of what they knew was coming for years. Disney pulled out of their film deal with Netflix 2 years ago to launch Disney Plus. Smartly, Netflix did just sign a deal with Sony Pictures, so that's going to help them over the next 5 years, questioning whether or not they should have just bought them. But, I do think that there are headwinds here on the competitive side that Netflix really has to face.
Yeah. Well, so what does that mean for the top of the funnel? I mean, we know churn continues to be low, so current subscribers seem happy with the level of content, Heather. But what does it mean for new subscribers then, and given these the competitive landscape that you're describing?
Subscribers are really going to have to choose how many services they want to subscribe to. Now, we've seen an expansion of that in COVID. So now subscribers, on average, the household has over 4 services in the video streaming space. So there is an increased appetite, especially as they start to cut the cord and save on their cable bills, to subscribe to streaming services. But there is going to be a reckoning over time and sort of a right sizing. And I think we're going to start to see Netflix's churn rates start to stumble a little bit. And we're even seeing some signs of that now.
Shepard Smith here. Thanks for watching CNBC on YouTube.